So let's get started now. Welcome back to our monthly webinar series, Capital Market Development, China and Asia. And today we're very happy to have Professor XIONG from Princeton, together with his co-author Jian and Zhenyu Gao. They will present us a very exciting latest study on belief and stock market performance based on large language model. We will also have Zhen from Yale, who knows a lot about the formation of expectation and how it affects the macroeconomy. So, Wei, the floor is yours. I don't think we need any introduction for you.
Thank you. Thanks, Michael. Let me share my screen. All right. You can see my screen, right? Right. All right. So it's a great pleasure to be back. I believe I actually gave the first seminar in the series a few years back. Today, I'm going to use this opportunity to present a new paper on structured beliefs and fund performance, LLM-based approach. I joined work with Zhenyu Gao and Jian, and both are here as well. So the paper is actually related to stock market and the China stock market in particular, relating to the theme of this series, right? So I think the China stock market is a bit special in many ways. I think it can be seen for many in the room familiar with what happened in the last few months, right? In September, China enacted a new stimulus policy. But what's interesting about this stimulus is that actually financial regulators announced a liquidity line offer to support the stock market, part of the economic stimulus, which is actually for those who are familiar with stock market regulation. Actually, this is a bit unusual because, of course, stimulating stock market without a market crash is something Western economy will typically try to avoid, because boosting stock market, of course, reduce firms' cost capital and indirectly reduce firm leverage, and can help with boosting market confidence and so on, all the good things. But at the same time, such a stimulus may also lead to a speculative frenzy, right? Which is actually many in other economy people are worried. But the boldness to take on such a policy measure reflects policymakers' view of market as a tool to implement state agenda. This is actually a notion quite familiar for policymakers in China, but rather actually is often sort of different, actually viewed from outside China market. And of course, this reflects China's economic model in many ways, right? Start the early stage in China's market reform. The agenda is 国家调控市场，市场引导企业, right? Means that state regulate market guide enterprises, right? So I think this policy measure actually very much reflects this basic philosophy. So the question we want to address in this paper is about how investors actually choose their investment strategy in a general sort of economic environment. Actually, the state the policymaker are often willing to actually aggressively intervene and actually using market to guide firms, right? And of course, I would be brief on this, Jen, because actually my last talk at the very beginning of the series is about China's hybrid market. I emphasized quite a bit that Chinese economy, after 40 years of market reform, now is a hybrid structure, right? So it mixes economic planning with market forces. And that means even though central planning is long gone, but the government still use planning, right? The central government sets priority for economic development, guide the resource allocation, regulate the market, and so on. And then use a top-down approach to direct and motivate local governments, and the local government then use incentives and regulations to guide the firms. So the market economy part often sits at the peripheral of the economy, right? but the market section of the economy provides better incentives to individuals and the firms. They provide market signals and the performance measures to the state system. In a way, sort of it's a mix of these two sides, right? And this thus leads to sort of the slogan to organize this market, this economy is 有效市场有为政府, efficient market combined with enabling government. So Chinese stock market basically sits sort of in the middle of this economy, right? It plays a very important role. Often, sort of, we know a lot of things about the stock market. We know it's volatile, it's speculative, right? So I have done a lot of behavior finance related work along this line. But I think today I want to emphasize another important feature, perhaps even more important feature of China's stock market, the strong influence of government policy. Right. This actually reflects China's hybrid economic model, as I just mentioned. Right. So in this environment, that means actually investors, not only retail investors and also institutional investors, need to work along a government's policy agenda. Right. So I worked on the model a few years back, trying to analyze sort of from theoretical perspective how intensive policy interventions by the government may affect the investors' information acquisition and thus their policies. While so the themes may sound very familiar to many people in this room, perhaps, but actually, if you want to come up with systematic evidence for it, it's actually very difficult. The reason is that it's very hard to measure beliefs, right? So how do you measure, whether investors care about policy regulation? Really need to sort of, if you want to come up with direct evidence, you have to ask investors what they are thinking. Do they care more about the economic fundamental, or do they care more about government policy? But we know it's very hard to come up with this kind of measures, right? So this is sort of is the challenge we face. Even though for people familiar with China stock market, this is something happen daily, right? But at the same time, because it's everywhere, actually sometimes come up with evidence is actually direct measures difficult. And of course, this is general difficult challenge to finance and also econ research, right? How do you measure beliefs? Directly measure beliefs is always difficult. So that's why sort of in academic research, we often go for an indirect approach, right? Come up with indirect inference or using structural models to estimate the beliefs and so on. The only thing sort of come close is sometimes economists also use survey data to survey household, to survey firm manager, to survey analysts or professional economists, ask for their views or their expectations about the economy, about inflation, and so on. But we know survey data has all sorts of limitations, right? Respondents may not be representative. The data may not be, their responses may not be consistent with what they do, and the sample may not be continuous, and so on. So it's even harder to measure structural beliefs. So in the context of, thinking about what investors care about policy, we know actually when investors anticipate the weak economic fundamental, they may expect the government to step in to stimulate the economy, right? So in China's case, when they speculate about what the government will do, right? This also requires some kind of structural belief, right? Because when economy is weak, government policy may kick in, but the government policy is supposed to to offset weak fundamental, right? So then you may end up having investors' weak fundamental expectation kind of counterbalanced by the expectation about government policy, right? Because they may offset each other. So this makes it even harder to analyze sort of this kind of structure in investors' belief. And this is actually exactly the kind of challenge we have to face if we want to understand how investors are going to think about policy in China. So on this, we actually will end up working with mutual funds. So we find actually very nice data. Mutual funds in China actually have to regularly provide the reports And in those reports, they have to document their overviews about what happened in the market, in the economy, as well as the outlook for the economy and for the market and the policy going forward. So basically, there's a structure in those reports. So we will study a mutual fund manager's beliefs through those reports. As some of you may familiar, actually, there's a rising sector in China's stock market, mutual fund sector. So mutual fund is now the largest institutional segment in the Chinese stock market, contributing to 7.6% of shareholding in China. And also, there's also a lot of interest about mutual fund in China. Interestingly enough, there's a recent report by Jian showing that actually mutual funds in China tend to outperform market indices, at least before fees. So this is actually in sharp contrast to U.S. mutual fund. We know U.S. mutual fund tend to underperform the market rather than overperform. So in some sense, how do mutual fund investors being able to do well in China is actually some of a puzzle, right? So that's why analyze their belief also help us to understand how do mutual fund investors trade. Okay, so the core of our study is about this mutual fund report. Since 2008, the CSRC has required all mutual funds to include the reviews and the outlook for the economy and the markets in their semi-annual and annual reports. So we basically collect all these reports. So as you can see from this table, there's a rapid growth in mutual fund sector, with the number of mutual funds rising from 280 early on to all the way to over 4,000 by 2023. So that means we have a lot of reports. Each mutual fund need to provide us a report every 6 months, right? So this gives a very large sample and is complete because all the fund here has a report. So the sample we observe is clearly representative, at least representative of mutual funds, all mutual funds. And also we have a continuous documentation because every 6 months there's a report to provide their views, right? And also we naturally know their trading, we know their performance as well as their holding as part of the report as well. So this makes it very nice. We can analyze their expectation together with actually how they trade. So here's a random report we draw. It provides this outlook for let me show the English version. Of course, the reports are in Chinese. Most of the reports are actually quite thorough. So here's an example. It's not super long, but nevertheless, it covers a lot of things. So this is a report from 2016. So it says, looking ahead to 2016, the biggest focus in macroeconomic policy is supply side reform. And look at the year ahead, it's a revival for the economy. It talks about the expected return rate needs to be lowered in 2016. This expectation, corporate profit will face short-term pressure. This expectation about the real side. RMB exchange rate is consistently under pressure. This is about the monetary side. And the U.S. entering a rate hike cycle. He mentioned the global economy as well, and also mentioned the implementation of the registration system will bring long-term structural change. So this is about the IPO reform. So in the regulatory policy. And 2016 will be a year of recovery for the stock market. This is expectation for the stock market. So basically, in a very condensed way, actually, this kind of outlook provides a lot of things, and also it provides some structure into sort of the outlook, right? So how they think of the economy, how they think of policy, and how this might interact with the market, and all of this. So this is actually a very rich text, provide a lot of structure. So basically, when this kind of report came to our mind, we thought that this is a gold mine. We can actually do a lot of work trying to understand the sort of the expectations, and actually what's interesting is not just sort of optimism about the market going up and down, right? It actually contains a structure, full structure about the economy and market and the policy altogether. Okay, so now the question is that of course. it's all in a textual form, right? So it's not the sort of digitized yet. So we need to find a way to extract the beliefs and the structure out of this rich text. As for some of you familiar with, so the classical approach is this bag of word approach, basically count the positive and negative word, which has been widely used in the finance and the econ literature. But this approach clearly is not suitable for our analysis. We actually tried. Actually, we spent a couple of years actually trying to work around this traditional approach, but it just doesn't work because, as you see from that example, it covers a lot of things. Might be, this manager might be positive, optimistic about the market, but actually pessimistic about the economy. So then, so the negative word and the positive what might mingle all together, but about different things, right? So simply doing the word counting won't work. And that's why sort of when large language model came along, we were very excited because actually GPT can actually really read the text and actually with proper prompting, it can tell us actually what does the report really tell us about the specific topic, right? So this is sort of the approach we are going to adopt. Basically, we're going to instruct GPT 4 to read each of these report and sort out each report according to 6 dimensions: domestic fiscal policy, domestic monetary policy, domestic regulatory policy, domestic monetary economic fundamentals, global economic fundamentals, domestic equity market, and domestic bond market, and also overall assessment for fund investors about the fund performance going forward. So basically, we ask GPT to read the report and to tell us sort of its assessment about the report's sentiment about each of these 8 dimensions. Response can be positive, weakly positive, neutral, weakly negative, or not mentioned, right? So, and also to be sure, we also ask GPT to provide sort of each response with a concise one-sentence summary of what actually the basis for the assessment from the report. So from this example I just showed you, sort of the GPT will tell us the fiscal policy is positive, monetary policy weakly negative, regulatory policy is neutral, but actually national macroeconomic fundamental is positive. So this is sort of the basically what we do. So we think sort of this LM really provides a very powerful tool. Now we can easily sort out this very complex and rich dense text, right, and sort out different dimensions. What we are doing, we really are just starting playing this. So we thought actually we can do a lot more. We can even read into the report and assess uncertainty, policy uncertainty, and so on, right? And even sort of, what each fund manager view, sort of others view, because sometimes often he also mentions sort of what's the view about the others, what others might believe. So there's a sort of a lot more dimension we can explore here. So here is sort of a summary. Basically, we asked GPT basically to rank sort of assessment, the sentiment in each of these 8 dimensions into sort of from positive being 1, weakly positive being 0.5, neutral being 0, and the weakly negative being negative 0.5 to negative being -1. So we digitized the sentiment of each report in 8 dimensions according to this kind of form. Of course, sort of, many are starting to use GPT and other LLM to do textual analysis, but there's a very important issue to bear in mind is to look at that bias. Several studies already pointed this out because LLM often rely on some text for training purpose, right? So GTP might have used previous text actually for the training purpose. So then it might actually know something actually what happened after this report, and then this might introduce some kind of a look at the bias, right? So it's while this sort of look at bias is important and relevant for predicting purpose, if you want to ask the sort of GPT to summarize text to predict the market, this might be a problem. But this is less of an issue for our analysis because we use GPT to summarize text. We don't ask the GPT to make any prediction, right? The goal is not to read the newspaper reports and to predict the stock market going forward, right? So we actually just want specifically ask GPT just to summarize, what's written in the text, literally. And in fact, to ensure robustness, we even implemented the measures such as removing years from the any reference of the years, or even change the dates by 5 years or 10 years, shifting the years. It doesn't really change much about the sort of our results are fairly consistent. Okay, so this will make us for our purpose. This is not a big concern. Okay, and okay, so once we have sort of extracted all this expectation, we already have a structure there, right? So we want to actually analyze sort of one particular kind of policy expectation, what we call counter-cyclical policy expectation. We know actually government is supposed to step in when our economy is weak. They need to stimulate it, but if the market or the economy is overheated, they need to sort of cool it off, right? So this is typical sort of, at least sort of, we know policymaker across the world. That's usually the guiding principle for policy interventions, right? So we want to extract a set of measure from these reports whether fund managers engage in this kind of counter-cyclical policy expectations. So we basically form additional dummies. Basically, if a manager believes that the current economy is currently in the downturn, by the way, so each report not only have outlook, it also have reviews. Basically, the report have two parts. First, assess what happened now, and then sort of this outlook for going forward. So basically, we also extract what's each manager's view about the current status, current state of the economy, current state of the market. So when the manager believes that the economy is currently in the downturn, but the government will adopt the easing policy in three of these dimensions: fiscal policy, monetary policy, or regulatory policy, to support the economy, then we define this dummy called CCPNX as sort of the managers engage in sort of positive cyclical policy, X dimension, fiscal policy or monetary policy or regulatory policy. So basically, sort of we construct sort of for each of the dimension we have a dummy, whether sort of the government have the manager anticipates government to engage counter-cyclical policy in that dimension. And there's a CCP measure, which is the key measure. If this dummy is 1, if the manager displays counter-cyclical policy expectation in any of the 3 policy areas. Okay, so this is sort of the key dummy we will be working with. And here's a quick summary. I need to be quick with showing you the result. We have the CCP measure. We also have each fund manager's expectation about equity market going forward and also bond market going forward, right? So, there's a typical concerns that maybe this fund manager, they basically have the module and the basically give the same thing every 6 months, right? They never bother to change it or not, or they may just do the same thing every time, right? So we can regress all these beliefs on fund fixed effect, on time fixed effect. We can also, fund plus time fixed effect. Interestingly, fund fixed effect only explain a small fraction of the variations in the sort of the expectation we extracted. For example, fund fixed effect only explain 9% of CCP fluctuation in CCP measure, this kind of cyclical belief measure. And time effect expand another like 12%. If we put the time and the fund fixed effect together, only 20%. That means sort of that 80% of variation unexplained. Basically, these are sort of not because they don't change anything, right? And also the same thing for expectation about equity market. Fund fixed effect only expand about 30% of the variation. That means some fund manager may tend to be optimistic, but that's kind of a fixed effect only expand 30%. Time fixed effect only expand 5%. So altogether, only 37%. That means sort of more about 2/3 of the variation still unexplained, right? Okay. So once we have the CCP counter-cyclical policy measure, we will label a fund to be a counter-cyclical policy fund if actually this fund display a fraction of its counter-cyclical policy expectations, about 20%. 20% is about the average frequency. All these fund measures display this kind of CCTP expectations. Okay. Now, let's look at the first compare performance of CCP fund versus non-CCP fund. You will see that, we can group together all the CCP funds. We can equal weight or value weight their monthly returns. And then we can request sort of their aggregate return onto, for some of you familiar with stock market in China, Liu, Stanbo, and Yuan has this very nice structure, 3-factor or 4-factor return for Chinese equity returns. So we can request on these factors. So, CCP fund do shows positive alpha. This monthly return, right? Depends on the measure. It varies from 49 basis points to 29 basis points, a significant positive alpha. We can also do the same thing for non-CCP fund. They also show some positive alpha, but nevertheless clearly actually smaller than CCP funds, showing this sort of direct shows that CCP funds tend to do better. We can also do the regression, panel regression, the fund level, not at the aggregated level, but to individual fund. We can regress sort of their return onto a bunch of factors, control variables, especially important the CCP fund indicator. Clearly, CCP fund do better. Again, whether look at raw return or, alpha after removing the 3-factor or removing the 4-factor is the same. Okay, so now you see that the actual CCP fund, for fund engaged in this kind of a policy, counter-cyclical policy expectations, that means so this is a kind of investment strategy, right? So they tend to do better. But why do they do better? So this is something we need to dig deeper. We will do this in 4 steps. First, we will look at the CCP funds. Because we have their market expectation about the equity market, about bond market, we can use their expectation to predict the equity market, the index return, and bond market index return. And we did find actually their expectation actually has substantial predictive power, especially more predictive power than non-CCP funds. Then we also look at whether sort of their expectation is related to their performance, their portfolio changes. Right, just say, well, whatever they say in the report, they actually have some bias, right? And indeed, we find the evidence for that. And also, we look at when they rebalance their portfolio to their rebalance, their trading predict the market returns. Indeed, actually, we also find positive evidence. And then finally, we're actually going to show that actually their predictive power, they expect they're able to predict the power, especially when they're engaged in CCP expectations. So this last step specifically tie their performance to their CCP policy expectations. Okay, so very quickly. So first, we put together all these several thousand funds. Each 6 months, we have the expectation, the equity market expectation as well, the expectation about the bond market. We use the expectation to predict the subsequent equity market return and the bond market return. You can see that there's substantial predictive power. And also CCP power here, especially when we interact their predictive power, when for CCP fund, you can see CCP fund clearly do better in predicting both equity and also in bond market. Okay, so this is the first step. And the second step, to make sure that when they become more optimistic about equity market, do they actually increase investment or they shift more portfolio into equity market, right? The stock ratio. Indeed, we find very positive evidence. When they show more optimism about the equity market, they do move more into equity market, and similarly for the stock. Okay, and then next. When they do change their portfolio at the time of their reporting their expectations, right? Do their portfolio change predict the equity market, or do their bond ratio increase predict the bond index. Again, we find very significant evidence for that. And especially for CCP fund, there are actually stock ratio increase have significantly more predictive power for subsequent equity market index return. And as well as same thing for the bond change, also bond ratio change also have significant more predictive power for bond index. So all this evidence suggests that CCP funds, for funds engaging counter-cyclical policy expectation, they do better for good reason, because they have better predictive power and they trade more on their more predictive beliefs. But then,
wait, so could you wrap up in 1 minute?
1 minute. I mean, this is the last table I want to show you. So then we also want to sort of, when they engage in this kind of, when they believe, we want to actually, the last table here shows that actually, when we use their belief to predict the equity market, let's say, when they're actually showing exactly when they also have a CCP expectations, their equity market predictive power is particularly strong. So this suggests that at least part of their performance especially relate to their CCP expectations. And the same thing, if we look at the CCP fund, their performance is especially strong when they have CCP beliefs. Okay, so let me wrap up. So basically, by sort out this mutual fund report, extracting the expectations, the structure in the expectations about market, about the economy, and about the policy, we can show that mutual fund managers' expectation about policy play a very important role in driving mutual fund managers' investment policy, especially these counter-cyclical policy expectations help mutual fund managers to perform better. So yeah, let me end here. Thank you.
Oh, thanks a lot, Wei. This is a very exciting presentation, also very rich presentation. So I decided to give Wei 5 more minutes. Zhen, now the floor is yours, and you still have 25 minutes. But if you would like to shorten a bit your discussion, that would be also fine.
Okay, let me share my screen. Can you see it properly?
Yeah, very good.
Okay. First, thanks very much for the opportunity to discussing this interesting paper. Let me give a quick summary. So I think this is a very intriguing paper. On the methodology part, the paper uses text as data and convert financial reports into beliefs where these large language models. And it contains 2 parts of the belief. One part is the belief on the asset prices looking forward, and this is directly payoff relevant for the fund managers. And the second part is more important. Also using this approach, you can identify the belief about the policy style, whether they expect countercyclical policy or not, or to which extent. On the applied side, the finding is that the investors who expecting CCP, the countercyclical policy or not, matters. In 2 ways. One is that the CCP investors are associated with a higher fund return. They outperform non-CCP investors. Second part is the CCP investor expected asset price is going to be more correlated with actual prices. And also these findings have potential implications. One part is this provide evidence for the role of state intervention in financial market. The second is evidence for the government-centric attention channel, which is related to with earlier work with Bruno Meyer and Michael Socking, and also the new paper with Socking. So let me first just have a quick discussion about this approach about the belief measurement. So if I want to summarize a different way to think about the belief measurement, you can think about maybe the 3 classes. The first class is a traditional belief inference. Suppose you impose some model structure and plus observed outcomes, you can use that to infer what the agent belief is. The traditional way is you impose rational interpretation, and more recently you can use, say, for example, adaptive learning, those kind of assumptions plus the model structure, you can infer what agent's belief is. And also this will imply fully structured belief. You can try to look at all aspects of their belief. But the issue with this is there's no direct evidence. It's mostly coming from the assumption. And the new generation for measuring belief involving, say, for example, using the survey evidence. And the survey evidence can give you direct and numeric measurement. But the problem is, as we mentioned earlier, there are many limitations. One important thing is the panel often unavailable. Maybe only the survey or professional forecasters give you actually a panel of forecasts. Others, especially for firms and consumers, typically is cross-sectional. You can also use text analysis, and this based on word frequency you can use to measure attention or sentiments. But typically, both of these two approaches difficult to infer what is the so-called structured belief. And this paper provides this text plus large language model. You can repeat the panel plus structured belief, and this allows analysis for investors' micro-strategy and together with the potential general equivalent propagation channel, and this open doors for further structured modeling of expectation formation. So I think it's a very promising going forward with this approach. So going to the particular question in this paper, the key question is how do CCP funds outperform non-CCP funds? And this is my understanding potential channels. The first one is maybe CCP funds, they have higher information quality. Their signal just intrinsically better than non-CCP fund managers. And the second is it could be that CCP funds and the non-CCP funds receive the exact same information, but the CCP funds they have more accurate mapping from underlying states to the prices. And both 1 and 2 channels will give you better expectations. And this is what I emphasize in the paper. The third possibility is maybe that CCP versus non-CCP fund, they have the same expectation, but the CCP funds have more sophisticated investment strategy. This is another possibility. So I'm going to give 3 comments on each of these 3 possible channels. The first one is about sort of like the first result one of the 4 results in the paper, whether CCP investors actually have better forecasts or not. The key idea in the paper is that the CCP investors are going to make more accurate forecasts. Ideal test for this story is you want to compare the forecast errors with non-CCP investors. That's the ideal test. But here we don't have the numerical forecast. Instead, we consider the following regression, which is you look at the realized equity price or bond price on the left-hand side, and look at the regress it against the forecast in the past. So if you look at this regression, the preferred interpretation would be that the positive gamma coefficient here will tell you that there's a positive correlation between the predicted and the realized prices. And the positive beta for these interactive terms can tell you that there can be even stronger association for CCP investors. So this is the regression, trying to tell you that there is a connection between the expected forecast, the expected price, and actual price. The caveat here, I think, is may not necessarily imply CCP investors have more accurate expectations. So why do I say this? It's useful to consider a very simple model trying to understand some of the channels here. Suppose that the investor I, either CCP or not, they want to forecast the return. I use RT and based on their signal XIT. Suppose as XIT is this RT, the return they care about, plus some noise, epsilon IT. And imagine that epsilon IT, this noise with the variance sigma I square, and the sigma I square going to capture what is the information quality. The larger the noise is, the worse the information quality is. And this information quality may depend on whether the investor is CCP or not. And if you want to do the forecast about this return RT, the forecast is going to be supposed to think about a linear forecast. The forecast is going to be, I want to write in a particular way like this, which is a kappa I multiply GI multiply the signal XIT. The GI will corresponding to the optimal forecast rule on the rational implementation, which is going to equal to this variance of the return RT over the variance of return plus the variance of noise. This is a signal to noise ratio. And this ratio can tell you what is optimal response to the signal or the sensitivity to signal. But often we also have additional term in front of it, the kappa I. This can capture potential behavioral distortions. Suppose kappa I is larger than 1, we say the investor may be overconfidence. Suppose kappa I is less than 1, we say maybe they are less confident than they should be. So this is a very simple framework. So suppose I run the regression in this simple framework, what I would find. So the gamma coefficients in the previous regression, you can, in this particular framework, find its theoretical expression, which depend on what is the variance of the noise, sigma I square, captured information quality, depend on kappa I, the behavioral distortion, and depend on GI, which is RE response to the signal in the forecast rule. So this would be the formula. So suppose I want to interpret this regression coefficient. There are multiple ways to interpret it. One of the interpretation would be the following. Suppose that all the different investors, they have the same information quality, but they have heterogeneous kappa I, means that they have different behavior distortions. If this is the case, if you have a higher regression coefficient gamma, it will imply that through this regression, you actually have a smaller variance of the forecast volatility, or corresponding to a smaller kappa I. The interpretation of higher gamma would tell you that more likely the CCP investor would behave like if they are underconfidence, do some level K thinking, credit discounting type of thing, which is they're going to have a smaller forecast volatility. This is one interpretation. I think the paper preferred interpretation is the second one, which is you fix a kappa I, means that everybody have the same behavior distortion, but have heterogeneous information quality in the sense that the sigma I square would be different. If this is the case, we will find that suppose you only vary sigma I square from the first part in the equation, then we will see that a smaller sigma I square means that smaller noise will lead to higher gamma, means that you have more accurate forecast. But the problem here is when you change the information quality sigma I square, the GI, the optimal response to it, also will move. These two things actually exactly cancel out each other, leaving this gamma always constant. It means that this regression coefficient may not be able to capture the variation in information quality. So this is the potential caveat. And I think one alternative way to run this regression is instead regress expectations against realizations, which is switching the right and the left. If you do this, the regression coefficient will directly corresponding to the responsiveness of kappa I multiplied GI. Then you can capture that whether they actually have a higher or smaller GI. I think this is maybe an alternative way to run this regression. This is the first comment. Second comment is about the mapping from the underlying states or policy to the prices you care about. So the challenge, I think, is for investors, supposedly, given that they hold this CCP belief, they believe that the government is going to do something to stabilize the economy. I think it's still challenging for them to actually predict what is actual prices. It is demanding to forecast the magnitude of the policy intervention. And also it will be demanding to evaluate what is the impact of the policy intervention. The mapping from the policy and the state to prices can be complicated. You need to know this mapping, this function to leverage on this government intervention can change the price and so on. And also to overcome these challenges require knowledge also about other market participants. And this is direct implication of a general equilibrium and structural belief, because the market outcome depend not only on this belief of a CCP fund, also depend on belief of a non-CCP fund, the consumers, firms, government, and so on and so forth. And if you want to really have this effective government-centric channel, I think it requires sufficient belief synchronization. And this will be an empirical question on the degree of belief dispersion across different market participants. And I will use one case study to shed light on this aspects. So here are the two graphs representing what happened to the stock market in the recent two intervention in China. The first one is during September 24th to early October. This is also mentioned in Wei's early introduction. Mm-hmm. So you can see that the two dashed lines correspond to the Shanghai index and the Hong Kong index, both on the one is on the left scale, the other is on the right scale. You can see that particularly after September 26th, which is the political bureau meeting, the meeting pledged to conduct expansionary monetary and fiscal policy. And you can see that the stock price responds strongly to it and increased. This is one of the intervention. The second intervention on the right which just happened last month, December 12th. You can see that this is the meeting of the Central Economic Work Conference. After the meeting also pledged to further expand the monetary and the fiscal stimulus to stabilize the economy. But different from the first intervention, you can see that the stock market actually responded in a way which actually the prices, the index decreased. So we see that these are two stimulating policy announcements achieved very different outcomes. And based on this, it's suggesting to say that it may not be easy to establish the mapping from the policy to price, even if you believe the government want to do something. So this is the question is, to which extent do you think that the CCP investor really understand and can actually accurately predict the mapping from the policy to the price? I think this is challenging.
So the expectation, what's the source of expectation in your plot?
Yeah, I'll mention that in the next slide.
Right.
Yeah. So the expectation is coming from this online survey on the micro and the small enterprises, and this is based on the premium work with Michael, Xiaohan Yang, and Xiaobo Zhang. So in the previous figure, you see that the expectation is for this micro and the small enterprises. You can think about the small firms. But what I want to really emphasize here is, on the same time, we can look at their belief about other parts of the economy. On the left is their expectation about the GDP. On the left is their expectation about the lowering rate or interest rate. You can see that on the left figure, after September 26th, after the stimulating announcement, the expectation about the China's GDP actually improved around roughly from 2.8 to 3.5. So there is a improved expectation about GDP. This is largely consistent with our prior or the textbook logic. On the right panel, you can see that the expectation about interest rate or lowering rate actually kind of fuzzy exactly what is the message they want to deliver here. So it's less clear what is the impact of the policy on the expectation about interest rate. So I feel like if we believe textbook story, and I believe that the sophisticated fund investor may anticipate that the expectation about the lowering rate, interest rate to decline after this stimulating policy, but this is not the case from the perspective of the firms. The question is, to which extent do the CCP investor internalize these facts when they're forming their own beliefs? Because if they really want to predict the prices of the market, these firms believe, consumers believe, also matter for the price. Do they believe that the government by themselves should be the sole player, or should they also think about other participants' belief as well? And what is the size of each party will matter here, I think. The last comment is about the investment strategy of the CCP investors. So the paper to explain the CCP, the fund performance, really focused on improve the expectations as the key channel. And the question is, what about the CCP investment strategy? So given they have the same expectation, could CCP investors have different strategy? For example, could it be that their portfolio choice more concentrated on the policy incentive industries? Could it be that their excess return mostly materialized during business downturns? Bottom line is, it will be interesting to understand whether their strategy are consistent with their government-centric beliefs. And also, to answer this question, I feel it's useful to consider some event studies. Say, do CCP investors really perform better around the government intervention window or not? And during those windows, do we observe this non-CCP investor actually switch to CCP investor after the salient intervention? I feel like these event studies could be useful to help to achieve a further identification. Yeah, that would be my discussion.
Thanks a lot, Zhen, for this very thoughtful and constructive comment discussion. Wei, do you want to quickly, respond to some issues raised by Zhen?
Okay, very briefly, I think thanks a lot, Zhen, for very helpful and insightful comments. I agree with mostly what you said. This is our first time actually use this method, right? So some of this we are still exploring. I think sort of the earlier sort of to your first comment about how to fully sort out whether it's really because of their information or maybe they're just less biased, right? So that's a very relevant issue. I mean, you suggest we flip it, right? We need to think a little bit more carefully. We haven't thought about flip this because we are actually running a predictive regression. Flipping that actually might be a little bit awkward from an econometric point of view, but that might be I know that I just today I discovered some typo in our draft. Actually, we missed the t+1 on the left hand side, so there's a typo there. But because it's a predictive regression, so then this is we will hesitate to flip it. But clearly, I think you're raising a very relevant issue, right? So CCP found to do better, maybe not because of their better information, but just because of their less biased. But that's why we sort of the last step is helpful. Maybe we should pursue more. Dig further into when they literally have the CCP expectations. I think that may help. And also your last comment about do some event study, really to pin down, right? So, around those events, when they have this kind of CCP, how their expectation change across those events can bring more kind of can reinforce sort of our understanding is really because of the policy, right? I think that's what you want to see, right? And also your second comments about what's your second comment about
how difficult to actually map to solve the
mapping
from
map.
Policy
sometimes it works, sometimes it doesn't work, right? So I think that's right. So I think on that actually we might be able to do what you said. So that's because we actually observe the full panel of all the funds, right? And if we can find the sort of, but of course, that one challenge we face is that the mutual funds they only report that. Do this report every 6 months at the fixed time. So sometimes it may not exactly line up with these big events, right? So that creates some bit of trouble. But nevertheless, we could actually, in terms of what their beliefs are coordinated, right? Because that's when sort of they really kind of affect each other. So on this kind of thing, we might be able to do, but we need to think about this sort of a more careful design. And in fact, actually, Zhenyu and Jian can add to me. So we are actually looking at something like from the text as a follow-up exercise. We are looking at the sort of sometimes they mention it's commonly believed by the market. The fund manager in report say 市场普遍认为. So this is actually they say, right? They think other people think. Certain things, right? So they are actually they often use this kind of phrases. So this is sort of relating to what you want to see, right? When certain expectation can really move market because they all think that way, right?
Yes,
but
that would be helpful.
From right now, so what we see so far at the very early, preliminary look is that interestingly, when one manager say, well, what 市场普遍认为 what he think other guys are thinking actually may not be the same as somebody else, another manager think the market widely believes. So apparently there's a higher order heterogeneity, right? So in beliefs. So all these things are clearly there. So that's why I think this text is very rich, and we can do actually a lot more out of it. We're just taking the first pass for now. Zhenyu or Jian, if you want to add anything.
Yeah, I think that's a very good point, and there's a big heterogeneity across belief, also different like high order belief right there. So I guess like at least we can specifically look at some specific events like you mentioned. Although this kind of low frequency report, but we actually can in a reasonable time framework we actually can check more about that. That's a pretty good suggestion.
Okay, so let's collect kind of first round of questions from our panel. Yeah, Bernie.
Well, thank you very much. I really enjoyed the presentation and the very insightful discussions. Let me try to think of it in a generic, at the very generic level. We always care about how the traders think about the future, whether they are thinking, whether their expectations are correct, how they form the expectations, and how they use the information. And the advantage of the LLM is that in the past we cannot go deep into how they do it. And now we may be able to get more, to read better on how they form, what their expectations are, and do so. And I think Zhenhu's comment is really about whether they are accurate and how they use the information, or how they use expectations they form. I want to raise the following question. The LLM has two issues. One is about the data leakage that Songwei mentioned. The other thing is that even when you're doing the estimate, my understanding is that the way you ask the question can lead to different readings. So there is almost like an error invariable kind of problem. So the prompting and all this can create bias. I wonder if you want to consider that. Then from that go on, I want to ask another question. Let's say everyone is adopting this kind of strategy, but they actually, more than just reading what people do, but they use the technique. They use the LLM technique to formulate their own expectation. So I go beyond just the researcher, but I'm saying the practitioners are doing that. So what does, at the end of the day, cause the pricing have a life of its own? They can create a bubble or that kind of stuff. So I do have to worry about that. And the third thing is that it seems that a lot of there are many similar papers popping up. In the past, we used survey and other econometric techniques, and now you're using LLM to study what people say. And for example, Jian has a recent paper that is also using this to read the sentiment and talk about how to use the sentiment to formulate, to predict the effectiveness or ineffectiveness of monetary policy. So there are a lot of things like that. Maybe I wonder if there are other related articles that you want to link with. Thank you for listening.
Wait, before responding to Bernie's question, so let's ask for kind of if there is any other panelist who would like to raise question. Patrick.
Oh, hi. Zhenyu and Jian's interesting paper. I'm trying to, so mutual fund in China have outperformance. It's a well-known fact. So here you are providing like more evidence of how they could achieve this alpha. So I wonder if you want to say more. Is it because they are using this countercyclical policy to do market timing, or is it they are able to pick the right industry? I think doesn't talk about this a bit more also. So I feel like right now the CCP fund level dummy is just used as a differentiation between two funds. I think you might want to do more along that direction. And also in China, mutual funds have mixed fund, equity only, bond only. So are you mix all these funds together in doing this regression, or you are? I would be interested in seeing that result for each category. Because mixed funds are these funds that can do more market timing, I feel. So maybe it might be interesting to take a look. And also you are mostly using this measure at the individual mutual fund level. I wonder it would be interesting to do an aggregate. So you have an aggregate expectation of countercyclical policy. And it might be interesting to line up with the overall stock market to see the aggregate indicator lines up with the aggregate stock market. Yeah. My last comment is, how do these mutual funds form their CCP belief? That will be, you read their document, you know that they have certain belief, but it will be interesting to see can we use market level indicators to form such beliefs? Like, fixed income market, yield curve, or other indicators. Can we link their belief to some observables? Okay. Yeah. So these are the potential, I guess, right, more things that you can do. Overall, interesting paper. Thanks.
Yeah, wait, please.
Okay, all right. Okay, let me quickly respond. First, thanks, Bernie and Jim, for these very helpful questions and comments. I think Bernie first raised this issue about hallucination, right? So we know that the LLM sometimes can do funny things, right? So that's why there are two things. Indeed, we need to be careful with prompting. How do we prompt it? We don't want to trick it, right? So that's why we want to make our question as simple as possible. And also, we know in these models usually there's a temperature indicator. We should set temperature to 0 to avoid as little this kind of hallucination as possible. And also, we make the question really simple. So that's why at the early stage, at the beginning, we are also getting comfortable with this method itself. So the question we asked are very simple questions. In principle, we could do more actually, because there's a structure in the text. We can potentially ask a more complicated structure, ask LLM to sort it out. But so far, we're hesitating on that. We basically want to train ourselves first how to prompt this. So far, what we are asking is very simple.
My understanding is that even if you ask very simple questions, different way you arrange the words can lead to different answers.
Yeah, exactly. So for that, we are also doing we are also doing we are validating the response as well. So far, we did a small sample validation. I think they're pretty reliable. We're doing bigger. So we eventually will show a full set of validation so far how they're reading it. To be honest, these texts are actually very dense, and the words are actually tricky. So this is I think it's a fair question. So when you read it, you will find actually sometimes, across the lines, they mentioned a lot of different things, right? So it is something actually necessary to use LLM. I would even if you can hire an army of IAs, you will find it's going to be very tricky to read these texts. So it's very painful to read because it's very dense and the structure is complicated. But I think the LLM can do a good job actually. So because with the problem, it's trained to do this, right? And you mentioned about the other studies. Actually, Jian also has a study along this kind of line, right? So studies, there are a lot of studies. I think for China's market, the policy is clearly the first order issue, if not the only issue really, right? At least in recent period, there's an increase in its so that's why understanding this kind of policy expectation is I think the LLM is kind of natural model. I think Jian has been analyzing the Politburo meetings and the impact on the market and so on. So clearly there's a lot of study on this. So Jian raised a lot of questions. So the empirical, I think Zhenyu can help with some of these questions. So we did do a little bit more on showing it's not just CCP dummy is not the way to select high probability managers, but actually in last step we do have some result actually clearly ties their better performance to to their CCP beliefs. I was a little bit brief at the end. Their performance is better when they actually display CCP expectations. So in that sense, it's related to that. It's not just because they're simply better managers, right? And of course, I think we want to do more, as Zhen suggested. Maybe we can find some events and then where we can tie clearly and also this is during your question, right? So how they believe this kind of policy expectation formed, right? So if we can find some more tangible events or some market outcome, maybe they could help. right? So we're exploring. So hopefully we will show some more concrete evidence. Then I think so that will help us understand better about font style. Yes, actually, most fonts in our sample are mixed fonts. So only a very small number of sort of a pure, say, bond font or something, because we want to mix. I think sort of for our sample is mostly mixed fonts. Right. So maybe Zhen, you can add to this.
Yes, that's right. So actually, the results actually mainly come from like a mixed font that's consistent with Zhen's intuition. Yeah.
I have one more observation. That in one of your tables, you have CCP fonts, non-CCP fonts. The CCP fonts clearly have a much higher market beta compared to the non-CCP. So I feel like you're picking two different type of fonts. Maybe, the nature of fonts might, you might be, it would be better if you can have a better control between these two group of fonts.
Sure. Yeah. We have some controls like age, like size, but we could do better in that.
Yeah. May I ask my question again to the research team? I want to ask the following following question. If you're right, let's say you're absolutely right. So everyone try to be a perfect CCP trader. What will happen to the price? Number two, the second part of what will happen to the pricing behavior? My second question is I suspect that it will my conjecture is it will raise if all the trading strategies converge because of your work. So it's inferential, so it converge. So I suspect that it will make the macro policy more inferential. My second question is the following. Suppose now every trader is using some kind of LLM to form. So it's not you. You formulate an LLM. You use LLM to formulate your understanding of the strategy, but they use LLM to formulate the understanding and predict the future. Would that create a sunspot equilibrium? My understanding is that the industry is using this left and right, as well as researchers. Right.
So you're saying basically the industry is already using to read these reports, and then this might feedback to itself, right? So because right.
Yeah. So they're using this to read.
They pay more attention to it. When the fund manager report, they pay more attention to policy. But everybody pay more attention to policy and so on. So this might be self-fulfilling, right? So I think James works on this kind of model, right? So I think right. I think the market actually may have. I mean, this report is provided every 6 months. So there's but there clearly I think so that maybe this mechanism is beyond these reports, right? So.
I think Winston Tao and Itay, they have a very interesting paper about this thing. Maybe we can invite them to come and present.
Okay, so since we're pretty close to the end of the webinar, let me thank again, the research team, Wei, Zhenyu and Jian for their excellent work, and Zhen again for his very insightful comments and suggestions. One thing that I learned is that this is indeed a gold mine. So we very much look forward to more follow-up works on this. And one more announcement is Bernie told me there will be no webinar in February, so nobody has to feel stressed in Chinese New Year holiday. So the next webinar will be scheduled to March 20th, right, Bernie?
Yes, March 30, which is again the third Thursday of the month.
Okay, very good. So thank you all, and bye-bye.
Thank you, Michael. Thank you, Bernie.
Thank you.
Bye.